Hello, this is the part 5 of your VITA training for VITA services for West Michigan. And today we're going to jump into some of the final information on the federal tax return. So talking a little bit about tax credits, other taxes, and finishing the tax return. So we're hoping to get everything all tied together in one neat little package today and finish this tax return information that we've been going through. We're going to jump right into it. So as I indicated, we're going to be looking at our non-refundable credits first, and then we'll look at refundable credits. We'll explain the difference between the two. And we're going to jump off where we left off. So we had just finished the income or the section on deductions and your exemptions. So right after that, after you finish your exemptions on line 42, the tax software will go ahead and start calculating and looking at non-refundable credits for you. So let's jump on into some of the non-refundable credits information. So credits, aren't they all the same? No, they are absolutely not all the same. They get calculated differently. They're very, very different. So a non-refundable credit, there's two different types of credits, a non-refundable and a refundable credit. A non-refundable credit cannot be used to increase a tax refund. It can only be used to lower the amount of taxable income or amount of tax owed. A refundable credit is treated as a tax payment, and so if there's even if there's a taxable income that is zero, a taxpayer can receive over that zero amount. So that hence the refundable portion. So it generates a refund. I know it's a little bit hard to kind of conceptualize that concept, so I wanted to go ahead and use an example. So if there's a non-refundable credit, say a person owes $500 in tax and they actually have a non-refundable credit of $600, even after that non-refundable credit is applied, the person still has a refund amount of zero. So if it's a refundable credit and the amount of taxes owed is $500 and that refundable credit is applied, then first the tax is paid off, that $500, but then beyond that, there's that refund of $100. So I hope that this kind of illustrates that a little bit easier for you to understand. A lot of credits are both refundable and non-refundable, so it'll start off with a non-refundable portion, and then a small portion of the tax credit can be refundable. So let's first start by looking at some non-refundable credits. So with our program with the VITA services for West Michigan, these are the common non-refundable credits that you'll be working with. So the Child Independent Care Credit, and that's used to offset daycare expenses. The education credits, obviously those are used to offset any education expenses if you're enrolled in any higher education or any sort of tuition for certification training. Some of that may be included. Retirement and saving contributions credit, so that comes into play when somebody has put some money towards their retirement. They do get a tax credit for that depending on income. And then the child tax credit. So all of these, with the exception of the retirement savings contribution credit, all of these are both refundable and non-refundable, but we'll talk about what each of these credits are right now. So the Child Independent Care Credit, that is when care is provided for a child, anyone under the age of 13, or it can be anyone of any age if there is some sort of physical or mental disability in place that prevents a person from taking care of themselves. They can have their caretaker or their guardian take them to a facility or have care come in, and at that point then dependent care credit can be examined. So it's basically in place so that it can guarantee that somebody can continue to go to their job and it can be used for work purposes. So if there's a child that's going to daycare to socialize, then that's probably not just the most, then that's not an allowed expense for the child dependent care credit. So where the calculation comes from, so there's a calculation that TaxSlayer uses, and it's basically just based on the amount of daycare expenses that have been paid. So what you absolutely need and what's typical to receive if there is somebody that's paying out of pocket for daycare is typically the daycare provider will mail a form to the payer or to the parents of the child. Will mail a form over there providing the child's name, the address of the daycare provider, the phone number of the daycare provider, and the social security or the tax ID number of that daycare provider. Those are all things that you need in order to prepare the return with this credit on it. Now, there are plenty of times where people come into our site and they don't have one of these. And I will say that while a lot of legitimate places provide this document with this information, a lot of places don't as well. So if the taxpayer does have this information and they don't have like an official document, that's fine. It's not required to come off of one specific type of form, but you do need all of this information. So just real quick, this obviously excludes any overnight camps or kindergarten or cost incurred through there. You must have that employer identification number. So that was something that's a fairly recent development, I'd say within the last 5 years. But the IRS is now requiring that you either have that employer ID number or that employer social security number. So that's for the daycare provider. You absolutely have to have that. Also, this is a credit that's mostly common in head of household situations or people that are married filing joint. So you need to have some income coming in order to show that you can pay those daycare expenses, but it can't be too high because the credit is kind of a sweet spot between the amount that's spent out of pocket and the amount of income coming into the home. And that's how that's established. So we're going to move on and talk about some education credits. We're going to spend most of our time on the American Opportunity Credit. There's two different types of education credits that the VITA programs work with. The American Opportunity Credit is the first and the Lifetime Learning Credit is the second. So with the American Opportunity Credit, it's provided for first year or first time students typically, at least a person that's pursuing their first post-secondary degree, so their first time going to college for 4 years in a row is really what this credit is designed for. So you can see on the screen we have to have what's called a 1098-T form in order to really be able to calculate the credit appropriately. It's got not only the amount of tuition that was charged to the person, but the amount of scholarships, which is huge because we need to subtract the scholarships from the amount that was billed. And then we also need that employer identification number that shows up over here and the establishment's website or the establishment's contact information, their address, and all of that information. That absolutely has to be put into the tax software in order to be eligible and to claim that tax credit. So with the American Opportunity Credit, you can claim up to $4,000 in qualified expenses. And some of those full list of the qualified expenses are in the 4012. The biggest ones that you'll see most commonly are books, computers or laptops, so technology, and tuition. So tuition, again, is really important where it's showing up on that 1098-T so that you can calculate how much was used for tuition. Because typically you're not going to receive like a printed information showing how much was spent on books and technology. So you've got to be prepared to ask the taxpayer or the client how much they paid out of pocket for those items as well. And also make sure that they know that they should have a paper trail of all of those items. If they don't have a paper trail, I wouldn't put it on the tax return just to cover everyone's butt. You'll want to make sure that there's paper trails of everything. So that doesn't exist and they can't obtain it, then I wouldn't put it on the tax return. Again, another stipulation of this credit is that it's minimum enrollment period. So the person has to be enrolled at least part-time for 1 semester. They also have to be pursuing their first bachelor's degree. So I kind of alluded to this earlier as well, but it has to be the first time somebody is pursuing that post-secondary degree, and it can be up to 4 years it can be claimed. But anything after that, they'd have to use a different tax credit or take the expenses and use them towards an adjustment on the tax return. One last quick detail as far as the refundable and non-refundable portion of this credit. The non-refundable portion is $1,500, and then the refundable portion is another $1,000. It can be paid even if it's with the utilization of loans. So you saw, I'm going to go back one slide. So even if this is coming from loans that were paid and were taken out to pay for the difference between the scholarships and the amount that was billed for expenses, you can utilize the loans as coming out of pocket. Even if it's a dependent, then this information goes on the taxpayer's return that is paying for the education. So if it's a college student that comes in and they're being filed on their parents' tax return, even if they file their own, this piece for the education credit is going to be most beneficial on that on the parents' refund and on their tax return that they file. You absolutely have to have that 1098-T. Also, another stipulation is that there cannot have been any sort of felony possession charge of a controlled substance. So the program will prompt you to ask some questions just regarding and making sure that all of these eligibility criteria are in place. Just answer them honestly through the software and you should be fine. But I know some of these questions are a little bit awkward to ask. Just let them know ahead of time that you have to ask for just because of the requirements of the credit. You want to make sure that you don't miss anything, but you also want to make sure that you're inputting their information only if they're actually eligible for it as well. I mentioned that there was another education credit, so the lifetime learning credit is another great incentive for education. It's just a slightly bit low, it's a little bit smaller than the American Opportunity Credit. So the non-refundable credit is up to 10% of school expenses, up to $20,000. That basically means that the credit itself is worth up to $2,000. So it's a little bit lower. It's $2,000 instead of the $2,500 for the American Opportunity Credit. But it can be used in different circumstances. So it can be used on any education level, and it can be used as many years as required or as applicable. It can be used if there's just courses being taken in order to improve job skills, and that's oftentimes what people who are going back to school and aren't pursuing a degree, that's a lot of the time why they're taking classes, is to improve their job skills. And then it does include tuition, book costs, even things that the grant that financial aid can't cover, and that it has to be covered through a loan. So kind of a lot like the American Opportunity Credit in that capacity. Again, the publication 420 is an excellent resource on that information. It can really help provide you some information that you'll need if you have any questions about what is an allowable expense or what isn't. It has a really good chart in it to use, so I'd like to encourage you to take a look at that as well. The retirement savings credit, that's being generated off of the W-2 or the income information on the tax return. So as long as that information is input into the software will actually do all the calculating for you. So you don't need to figure out what the credit is or how it's being generated. Just know that it's coming from the W-2 and from the income information. And know that the income range is going to vary a little bit just depending on filing status. So the credit usually isn't worth a ton, but it can be worth up to $1,000, although I've never seen it that high at our VITA sites, but it can be up to $1,000 or about 10% of the contributions, and it has to fit into these different price brackets too. But again, I just want to let you know that the software will calculate that. and know that that credit is available. We usually don't have too many questions on that one, actually. So I do want to touch on the child tax credit and the non-refundable portion of it. The non-refundable and the refundable credit pieces are the same as far as qualifications for the credit in that piece. The difference between refundable and non-refundable in a lot of these circumstances is just that it's being applied first towards any of the tax that's owed. But anyway, the child tax credit is another huge tax credit that we really try to encourage all of our participants to apply for. The child has to be under the age of 17 on the tax return of the last day of the tax year. So know that that's a requirement. I know the age is a little bit off from what you think it might be, but if you think about it in terms of people being able to claim children that are born when they're born, you can claim them. So that's why it's age 17 and not age 18. But anyway, the taxpayer must have a qualifying dependent. So the child has to have lived with the person for like 6 months or 6 months at least and over. And the child could not have provided half of their own support. So the taxpayer has to have provided more than half the support for the household. The child must be a U.S. resident and must have a Social Security number or ITIN. There also has to be some earning stipulations in this circumstance. So the household must have at least $3,000 of earned income, and the credit can be worth of up to $1,000 per child. So sometimes the household may not hit that $1,000 point. That might be because their income is too high or too low. It has to be a very special spot, and that's just dependent on how much income is in the home and how many people are in the home. That kind of adjusts where that lands. So any of the unclaimed child tax credit, so let's say there's an excess amount of the child tax credit, you can actually have it go as a refundable credit and the additional child tax credit. So that is kind of a nice piece about these non-refundable credits, is a lot of the ones that we work with have a refundable credit portion available, which is excellent. So I did want to touch on other taxes, so the self-employment tax as well as the additional tax on early distribution. These will be calculated automatically by the computer, but I do like people to know where they are and what they are. So the self-employment tax is something that basically is a tax that's added to the return for being self-employed, just because when you're self-employed, you're obviously not paying out of pocket for a lot of the taxes that are imposed upon you. So the self-employment tax is in place. Do remember that about half of that is an adjustment that's on your adjustment side, so you're not paying that full amount realistically. There's also that additional tax on an early retirement distribution. So if somebody takes some money out of an account before they're 59 and a half, and they don't do it for some of the reasons that the IRS indicates are eligible for it to be tax exempt, if you don't go through that process, then it's coded on your distribution, on that retirement distribution, and you end up having to pay a penalty on it if you do that early withdrawal. So just know that that's a circumstance and a situation. We don't come across it too often at the tax sites, but it is something I want you to be aware of, because there are some circumstances and some of the exercises that talk about early distribution and some of the practice problems, and you do want to get a good grasp on what is what's an early distribution and how that impacts the return. And basically an early distribution is taking out the money before you're of age to do that. And then there's certain penalties that come into play. A lot of the time there's an extra 10% penalty for any of the distributions if it's taken out before the taxpayer is 59 and a half. So there's different things for different circumstances. All are coded on those income statements, which is why it's so important for you to fill out the income portions appropriately and correctly. So I just wanted to touch base and let you know that those taxes may show up on the tax return. Don't be afraid, but do know why they're there. So the self-employment tax is there if somebody is doing their own Schedule C for their own small business, or if there's a 1099-R and somebody has taken some sort of a retirement distribution early, then they're going to get penalized for that as well. Also, another tax that shows up is the premium tax credit. So that may show up as a tax or a fee, basically, and that's for not having proper insurance coverage. So we're going to get into a lot of information about the Affordable Care Act, and I'll explain to you the ins and outs of it and where it works. But just know that under other taxes, if somebody has not paid for their insurance like they should, that's where the tax comes up. So do know and be aware of that. So we're going to jump into some of these refundable credits, so the better part, and basically the things that are going to, in theory, be really increasing some of the tax returns that we're working with. So just to touch base real quick, there's an additional child tax credit, so the refundable portion of the child tax credit. There's also the education credit, which is a refundable portion still currently. If that changes, it will be in the near future, because I haven't heard of any rumors or anything on that changing anytime soon. So if it comes up, it comes up, but right now that's not an issue. There is no issue with anybody obtaining that credit or with it going away in the near future. The premium tax credit, again, that could be a negative, that could be a positive. So we'll talk a little bit about what those two implications are, but just know that a premium tax credit from the Affordable Care Act may show up in your refundable credits portion. There's also that earned income tax credit, which is so huge. It can be worth more than $6,000, and it's really one of the best anti-poverty tools that we have here in the U.S. So let's jump into this, refundable credits and payments. So we're going to talk about the refundable credits and payments portion. Just a few more things on some of these tax credits. So I know we've gone through a lot of them in the non-refundable portion, but just a few things I want to point out as far as what they are for the refundable portion. So the child tax credit is basically the same. The information is going to be pulled from that section from your dependent information that you're putting in. So if you think somebody's eligible for this, the whole child tax credit, so the refundable and non-refundable portion, one of the things that goes into place is keeping that age circumstance and that they have to be under 17, keeping that straight in your head. So if that's not indicated appropriately, if you accidentally type in the wrong year for the date of birth for the child, that might be what's driving it. If you think that somebody's eligible for a credit and it's not being generated through the software. So all the same circumstances apply for both the refundable and non-refundable portion. The credit itself is going to be based on the income of the taxpayer, as well as that age and residency requirements of the taxpayer dependent. So again, if they're the big thing is the age, and that's what usually throws most people off when they're talking about that tax credit. So the education credit, so the non-refundable portion of the American Opportunity Credit we've talked about. The refundable portion is the $1,000. So you may see that $1,500 shows up on the non-refundable portion piece, and then $1,000 shows up under the refundable portion. So it can be in two places. So if you don't see it one, look under the other. They should total up to the amount, to the maximum amount of the credit value if everything else is in place for them income-wise and residency-wise, and you do all the different tests on it that way. Again, it's for the first 4 years of a degree, and it can include the books, tuitions, and school fees. And it can also be anything that's paid for with student loans. One thing I do want to point out for the refundable portion is that if somebody is under the age of 24, that refundable portion is not going to be eligible to them. So that's another reason why I like to point out that it's usually most beneficial for the person's parents to claim them. So if somebody is under the age of 24, they typically are coming from a household where their dependents are claiming them even though they're in college. In which case, even if that 24-year-old is doing their own tax return, that's why, again, we want to make sure that this portion, so that the refundable portion can be claimed by somebody, that it's being claimed on the parent's tax return. The earned income credit. So there's different rules for filers. Just make sure you look at your 4012, and it has some great information in it. So just real quick to go through the earned income tax credit, it's a huge benefit to people. Like I said, it's worth over $6,000 in some cases. So to summarize and make sure that you have all the information you need on that tax credit, there has to be valid Social Security numbers, and then that has to be valid for work as well. There has to be earned income. So I know it sounds and seems obvious, but every year we still get people coming in that receive Social Security as the only income in the home, and they want to know why they're not getting their earned income tax credit. And that's because their wages were not earned. It's because those are just wages that are provided to the taxpayer, but you have to have earnings. So you have to have either self-employment or W-2s or wage forms, and that's what that equates to. There cannot be the person with the earned income tax credit, so they can't be a dependent on another tax return. So keep that in mind. They can't be a dependent or a child on any other tax return. There can't be any sort of investment income above $3,350 or foreign income. That obviously is not an issue that comes up so much at our tax sites, but it is an issue, so I do want to make mention of it. The filing status cannot be married filing separate. So I did talk about this a little bit in our filing status section, but I do just want to reiterate that, especially for the earned income tax credit, that's where the marrying filing separate can really impact that tax return in a negative way. So again, if there's any way to file any other filing status aside from the married filing separate, then highly encourage it and make sure that the person can get their earned income tax credit that they're entitled to. The earned income tax credit is based basically on a sliding scale based on earnings, and then the amount of people in the home. There's a good instruction guide that shows that huge table. If you ever need to reference it, let your site coordinator know. But as long as you follow that 4012 material and really get used to the different residency and age and relation tests, then it should be pretty easy. Again, you'll want to make sure that the person the dependent, the person has a valid Social Security number and is related to the person that's filing for them. They're not related, again, that's okay, they can be filed for, but they had to have been in the home for all 12 months and no one else can be claiming them as well. So if it's somebody that's living with them that is their dependent, so that is their child, then that child only has to be living in the home for half the year. The child must be under the age of 24 for that earned income tax credit, or and that's if they're in school, if they're in college or another training program, or they have to be 19 and under if they are just student age. But anything older than that, they have to be permanently disabled at any age, or they are not eligible for the tax credit. Again, and I know I'm beating a dead horse on this one, but the dependent cannot be claimed on any other tax return. So I wouldn't say it if it didn't come up all the time, but it does. So I want to make sure that there's a clear understanding of that. So the earned income tax credit is for the tax filers is for tax filers that do and don't have kids, but I will say that it is very difficult to get the earned income tax credit if you don't have a dependent. You cannot have kids, but it's only going to max out around a little over $400, which is still a good amount of money, which is still a nice credit. But the person that's filing has to be at least 25 and they have to be under 65. They can't be a dependent on another tax return. And again, they can't be doing the married filing separate return. They also have to have lived in the U.S. for over half the year in order to be eligible for any sort of earned income tax credit. So nothing too substantial or difficult about the earned income tax credit if there are no dependents. Just know that the amount is not going to be nearly as high as it is when they do have dependents. So that earned income tax credit is basically the last credit that we have to go over. The amount of withholdings is applied, so everything that was already withheld from the taxpayer's paycheck, that's then applied to the tax forms, and that's when you end up at the end of the taxes. So you'll either be shown an amount due or an amount refunded. So if there is an amount due, so some of the finishing touches and some of the things to know that are in place. If there's an amount due, there's a few different options that the taxpayer has. They can either pay with a credit card, they can have a form printed out, and they can mail that in and mail a check to Treasury. They can pay online, or they can have the funds automatically withdrawn from their bank account. And we can set and help everybody at the anybody with any of these circumstances coming in. We can give them either the information to send in their amount that's due or to contact Treasury. So we have the information to help people do that, and those are basically the four main options of getting the amount that's due paid off. Now, people will definitely want to avoid paying in the future, so if they've been working, they can have a new W-4 form filled out. The W-4 form is what dictates how much income or how much earnings are withheld for taxes. And what that can do is make it so that there's no additional penalties from withholding or from underestimating how much you owe. You could also do estimated taxes, which is another good option. That's something that a lot of VITA clients do, where if they know that they're going to owe each year, they go ahead and mail in they call quarterly payments, and that's where you take an estimated amount of what's due and mail that in. If you mail in too much, then through the tax return we reconcile that amount that you should have paid and how much you did pay, and then we can get that refunded for you if you overpaid. If there is any sort of direct deposit, the refund should come in about 10 to 14 days on the federal side. If the taxpayer wants to have their refund mailed to them, it can take between 5 and 7 weeks. So we do encourage people to direct deposit. It's much more prompt, it's much more quick. It's also a lot safer. So we know, and the client knows that that money is going directly into their bank account, and that's it. Some other options is you can split a refund, and you can do that using Form 8888. So that way what you can do is you can have a portion of the refund go into a savings account and a portion of the refund go into the checking account. So both are, the Form 8888 is a really useful tool, and we do like to encourage people to utilize that. Also, if somebody would like to purchase a savings bond, they can do that with Form 8888 as well, although we don't see that very often. Once you think you've gone through all the information, you've touched everything you can on that intake and interview form, and you think the return is completed, you'll want to go through, as the tax preparer, you'll want to go through a quick little quality review process before you have a quality review done. So that quality review sheet can be accessed on the intake and interview form. It's right on there, so you'll want to double check all that information as well. You'll want to double check that that you have the right social security numbers in the return. You'll want to make sure that the ITINs and EINs are printed on the tax return, that all the information is correct, that you're on the same page for the filing status and how many dependents are in the household. Double check and make sure that there aren't any pieces of paper sticking together and that all the income has been accounted for and documented. Also, that all the adjustments are correct. You'll want to make sure that the correct either standard or itemized deduction has been appropriated, and then you'll want to make sure that any of the credits that you thought that the client would be eligible for are accounted for on the tax return as well. The withholdings that show up on the last page or towards the end of the tax return should total the total amounts from the W-2s and 1099s and estimated taxes payments. And then one of the things that you'll definitely want to do is double and triple check the direct deposit banking information if the person is having their tax return direct deposited. And then at that point, you'll want to make sure that you'll have a quality review done on the return. After the quality review is done by another tax preparer, then you'll print out the tax return and you'll go through it with the taxpayer. Make sure that you both are on the same page with that with each other, and that you give them all of their documents back. You give them their copy of the return. You make sure to update the status of the return as being complete so your site coordinator knows that it needs to be e-filed. And then you thank the client for coming in after you get everything put into an envelope for them. Also, you want to make sure to include in that envelope there's a form that's available at the tax site that indicates and provides instruction on how somebody can look up the status of their refund. We'll want to make sure to give that form to the clients as well. After that, you take a couple minutes for yourself, and then you'll be ready to go for your next tax return. So that is the basics, a very nitty-gritty and quick and dirty version of what you need to know for preparing our very basic VITA volunteer taxes. Make sure you stay for the Affordable Care Act module to get completely up to date on all the insurance information you need to know and how that impacts our tax returns. Stay tuned definitely for the modules on the state credit and the local or city credits as we call them, and that you get started on the tax returns and doing some practice tax returns yourself. I hope by now you will have started some on your own. There's some great practice and review videos online that are posted that Carl did for you, so don't miss out on those as well. As always, if you have any questions, make sure you go to our website, www.vitawestmichigan.org, or contact Carl Lewis, and his information is on that website as well. Thanks so much and have a great day.